If you're starting a business and you don't have year one financial projections, you're just reacting to fires that come up, and that can lead to expensive mistakes. So whether you're launching a startup or finally turning your side hustle into a real business, your first year projections can help you plan and prepare for bumps or potholes in the road to a growing business. First year projections are unique compared to regular financial projections, and in this video we're going to break down exactly what needs to be in them. Financial projections aren't just for banks or investors. They help you answer, how will sales impact my other costs? When will I break even? How much cash do I need to raise or finance before we break even? Will I have enough cash to pay myself? Start with revenue. Identify every income stream such as products, services, and subscriptions. Then project it monthly, not just annually. Monthly projections help you spot the slow seasons, plan hiring, and manage cash flow. Even if you're pre-revenue, or you've just started making sales, break down how many leads you're generating each month, or realistically expect to generate based on your current marketing sales efforts. And from there, estimate what percentage of those leads will turn into buyers. And this is your conversion rate. Multiply the number of expected customers by your average product or service price in order to get your revenue. Your price is an important assumption in the forecast. Don't sell yourself short based on the value you deliver and what the market's willing to pay. Even a small increase in price can have a significant impact on your bottom line. And here's the key: be conservative in your projections. It's better to outperform your numbers than chase unrealistic ones. Next, look at your direct costs. For product businesses, that's materials, production labor, shipping, and for service businesses, it's contractor pay or client-facing labor. Gross profit is revenue minus these direct costs. And you need to generate enough gross profit margin to cover your administrative expenses and your profit share or salary. Your direct costs should change with volume, so calculate the cost per individual service or product to drive your assumption for this category. Now layer in administrative and general operating expenses: rent, software, insurance, marketing, and administrative payroll. Separate the fixed and variable costs. This helps you calculate your break-even point, the minimum revenue you need to cover your costs. Include your minimum salary profit distribution as a fixed cost as well. The business is not covering its costs if you're not being paid. And don't forget to also consider startup investments such as equipment or furniture or one-time marketing launch expenses. These may be heavier in the early months of the first year, and the forecast will help you identify how much cash you'll need available to fund those early months. As you're thinking about how much you need to pay yourself, don't forget about taxes. The amount you need to cover your personal expenses isn't the full picture. Your actual minimum payout to yourself has to be higher, because a portion of what you take home will go towards taxes. Unlike a traditional paycheck, there may not be automatic withholding on the money you pull from the business. When you're building projections, make sure you're planning for this tax liability. Year one financial projections aren't about predicting the future perfectly. They're about understanding the feasibility of your business model and mapping out how business decisions can impact your profitability and growth. Looking for more small business finance tips? Subscribe to our channel today.